So today, like I said in the room just moments ago, and we're going to record this and throw it up on YouTube, it was less of a Calvin Klein day, more of a Haynes or Fruit of the Loom. Not that it was bad trading, just it was for me. The calls weren't as clear, but that happens. There were some good moves though, and there were a couple ideas, but no decent trades attached to them, at least not yet. Tomorrow, which is Friday, April 5th, we'll have the unemployment report. But right now, I want to show you market correlations. That's what's important with this market correlations. One of the things that could have helped create a downside bias that we talked about in real time before the downside took place is comparing and contrasting two markets that are going to trade or chart similarly. So on the left, we've got the Dow, and on the right, we've got the NASDAQ. And I got a global cursor crosshair to show the what's going on in both markets around the same time, right? So if I leave this vertical white line right where it is, all right, you're going to see on the right, you're going to see the highs in the NASDAQ, and you're going to see on the left, see these highs up here, and you're going to see on the left, I'll put it back over here, you're going to see highs in the Dow. So that's happening together, higher highs together, correct? Higher highs. But watch what happens, and let me get rid of the global cursors and just put a drawing on it instead. Take a look at this as being a high at the same time as that was a high after the open. Those two took place at the same time. Dow, NASDAQ. The Dow does what? It comes down and it chops sideways here on the left. The NASDAQ comes down a little more and chops sideways as well. Now, this is what and how you read a chart comparing and contrasting. The Dow comes back up out of this chop and makes a higher high, right? This high right there is higher than that high right there. So we call that a higher high. So now we come by and we say, well, what does the NASDAQ do? They don't even get kind of close to their highs over there. So that's a kind of an intermarket divergence. So you get a higher high, higher high in one index, but not the other. It's showing you that this one is weak and this one is strong. So the next logical question, and I get it all the time, is would you sell this one or buy this one? And that's a good question because you're starting to think now on logical terms. It's if you're bearish, you'd rather sell the weaker one, but at least you made the determination that one's weaker that you couldn't have said if you didn't compare it to something else. That car dealership example. How do I know that this car is cheaper? Because the other ones were more expensive for the same car. Now, this ain't the same car, but it's similar, right? NASDAQ and the Dow have different stocks that make them up. But you do this with the Russell or the ES or the German DAX, which was also strong this morning. So when you start doing it, it gives you more confidence that the weak one, there's a tug of war, and the weak one, if it starts rolling over, could get pretty weak pretty fast because it couldn't make highs in that sequence there. Even though the Dow made highs, the Russell made highs, the German DAX made highs, and the ES, I think, double topped. So then you take a look, and what we did in the room is talked about the congestion box all being in here. And don't be long. There's sell stops below that 87 even area. That can't be, now that you're watching these videos and understanding it, that can't be a surprise that the market got going to the downside quickly. Why? Because it left this consolidation box. And when it left, it was gone. Went to this support, chopped, went to, well, this support worked over here, drove through it, got real weak real fast, and it brought the ES along with it, and even the Dow, along with it. So that's what's important to to do in a market relationship scenario. And if you guys do a Google search for market profile, for volume profile, for even order flow, for stochastics, for relative strength, for Fibonacci, you're going to get hit with a lot of people telling you about it. Do an internet search for intermarket correlations to find value on an intraday basis. You'll find nothing. You might find people comparing, contrasting on long term. How many people talk about this? And that's what's important. Try to do something others won't ever, even though this can be on a YouTube video, others are never going to understand. Trust me when I tell you it. I could tell someone it on the phone and they still won't believe me. That's how hard-headed most retail traders are. Compare, contrast to distinguish strength from weakness to help build your bias.